Hey everyone, welcome back to Gold Rush Reporter, your trusted source for real talk on gold, silver, and the changing dynamics of the precious metals world. I'm your analyst, and today we're diving deep into a problem that a lot of silver investors are quietly noticing: a sudden slowdown in the silver market. Dealers are getting cautious, refiners are pausing, and everyday stackers are asking one serious question: should I keep buying silver right now? Let's start with what's happening on the ground. Many small-scale dealers and even regular customers are beginning to notice that the flow of silver isn't what it used to be. Some local coin shops have actually stopped buying certain forms of silver altogether. Not because they've lost faith in the metal, but because refiners, the companies that melt and recycle silver, have temporarily stopped purchasing from them. Without refiners taking in the excess silver, many dealers are stuck holding inventory they can't move. So even though spot prices look decent, the actual trade, the physical buying and selling, is slowing down in some regions. Now, that's where the concern starts. People wonder, if dealers aren't buying, will I be able to sell my silver later? It's a fair question. Traditionally, silver investors depend on a chain: the dealer, the custodian, and the depository. But in this current environment, the system feels a bit jammed. Some retailers, like SD Bullion for instance, emphasize that they manage both storage and retail operations themselves. That helps them stay flexible even when the broader refining system slows. It shows how choosing the right dealer matters more than ever, not just for buying, but also for having an exit when it's time to sell. But here's the bigger picture. This pause doesn't mean silver has lost its value. What we're witnessing is more like a short-term supply chain hiccup, not a collapse. When prices spike or physical demand surges suddenly, refiners get overwhelmed. They receive so much silver from sellers that their melting and refining capacity hits its limit. So, they temporarily stop buying until they process what they already have. During that pause, dealers have to slow their intake. And that's when small investors feel the ripple effect. So, should you stop buying silver? As a metals analyst, my view is no, but with strategy. This isn't the time for panic or dumping your stack. It's the time to understand why markets behave this way. Silver's long-term fundamentals haven't changed. Industrial demand is still growing in batteries, electronics, and solar technology. The problem right now isn't a lack of demand, it's logistical congestion. When refiners catch up, the flow will resume. But yes, the transition might take weeks or even months, and during that time, patience and positioning matter. Think of this phase as the metal market catching its breath. In every bull market, you'll have pauses where liquidity tightens. That's when experienced stackers stay calm and newer investors get nervous. But those who keep their discipline, maybe buying smaller amounts or diversifying into more liquid forms like silver eagles or maples, often come out stronger. Because once the backlog clears, the refineries reopen, and everyone rushes back to sell or buy, the premiums and opportunities will shift fast. So if you're sitting there wondering whether silver's future is in trouble, it's not. What's happening now is a momentary blockage in the pipeline, not the end of the road. In fact, this kind of slowdown can create excellent long-term buying opportunities once the dust settles. And as always, I'd love to hear from you. Are you still buying silver during this slowdown? Or are you waiting it out? Drop your thoughts in the comments. I read every single one. Stay tuned, because in part 2, we'll dig deeper into what causes bid-ask spreads to move and how real-world silver pricing actually works behind the scenes. Now let's move into the real concerns that many investors and everyday silver stackers are facing right now. Some customers have started noticing that local dealers aren't buying as much silver as they used to. In fact, a few coin shops have stopped purchasing certain types of silver completely until refiners begin accepting metal again. This situation has created a wave of uncertainty. Many people are asking the same question. If it's already getting harder to sell silver, should they even keep buying? This is a very important question. The truth is, we are currently in an unusual phase of the silver market. Refiners are temporarily backed up. Because the silver price spiked sharply, a lot of old silver, sterling, 90% coins, and even war nickels came out of hiding. That created a flood in the refining system, which slowed everything down. Refiners are now taking extra time to process that backlog, which means dealers are struggling to move the excess silver they already have. But this doesn't mean the long-term silver outlook is bad. It just means there's a short-term bottleneck. Whenever the market experiences this kind of pause, it's actually part of a healthy cycle. Think of it as the market taking a breath. Silver demand from investors, industry, and technology is still very strong. However, when refineries hit capacity, dealers can't process metal fast enough, and that leads to temporary slowdowns. Now, this is why it's crucial to understand how your dealer or supplier operates. The company structure matters more than ever. In traditional setups, you have three main entities: the dealer, the custodian, and the depository. The dealer sells you the silver, the custodian holds it for you, and the depository stores it securely. But the reason some firms, like SD Bullion, have stayed stable is because they control more than one of these parts, both the retail and depository sides. That means less dependency on external systems and faster transaction flow for the customer. When the market is under pressure, that setup makes all the difference. It's why some buyers continue to have smooth transactions while others face delays or refusals. As analysts, we always tell people that who you choose to buy from is just as important as when you buy. A reliable dealer can still provide liquidity even when the broader refining network slows down. At this point, one thing becomes clear: patience and understanding. The market cycle are key. Right now, the issue isn't about whether silver will lose value. It's about how the logistics of refining and selling are temporarily affected. Silver isn't going anywhere. The demand for it in solar, electric vehicles, and technology will only grow stronger in the coming years. But like every commodity market, silver sometimes faces congestion points that slow the flow between buyers, sellers, and refiners. If you're a long-term investor, the right mindset is to treat these slowdowns as opportunities. Remember, whenever panic sets in and the weaker hands stop buying, that's usually when disciplined investors quietly accumulate more. Buying in a dip or during a slowdown has historically led to strong returns when the market rebounds. But the key is to buy from trusted sources, not from random sellers or unverified platforms. So, if you've been wondering whether to keep stacking, the answer depends on your goal. If you're building long-term wealth and protecting against inflation or financial instability, silver remains an excellent choice. But you have to be strategic. Choose liquidity, reliability, and timing carefully. Right now, we're simply seeing a temporary jam in the refining chain, not a crisis in silver's value. Once refiners catch up, the system will rebalance. Those who stayed consistent and patient will be the ones who benefit most when the silver cycle swings back in full force. Now, let's talk about the emotional side of what's happening in the silver market. because this part is just as important as the technical details. Right now, many investors are confused. They see prices dropping, dealers slowing down their purchases, and social media filled with mixed opinions. Some people are saying the silver market is dead, while others are claiming this is the biggest buying opportunity in years. So, which one is it? The truth lies somewhere in between, and understanding that balance is what separates smart investors from the rest. When markets slow down or prices dip, emotions often take control. Fear and uncertainty cloud judgment. Some investors panic and sell too early, thinking they're saving themselves from a bigger loss. But what they don't realize is that these moments of weakness often transfer wealth from impatient hands to patient ones. Every major bull market in history, whether it's gold, silver, or even stocks, has gone through these emotional roller coasters. The winners are always those who stay calm, gather information, and act rationally. Silver is not a get-rich-quick asset. It's a hedge against the system, against inflation, currency devaluation, and reckless government spending. So when you see short-term volatility, that's not a reason to run. It's a reminder of why you invested in the first place. The big players, central banks, institutions, and wealthy investors know this very well. They don't buy when prices are soaring. They accumulate quietly when sentiment is negative, just like right now. If you look closely, the fundamentals of silver are stronger than ever. Industrial demand continues to rise, especially in green energy technologies like solar panels and electric vehicles. The world is transitioning into an era of electrification, and that means more silver is required every single year. At the same time, global silver supply has been tightening. Mining output hasn't increased at the same pace as demand, and recycling has limits. Combine these two factors, growing demand and limited supply, and you can see the setup for a powerful future rally. But despite this, short-term prices are still influenced by paper markets, futures contracts, derivatives, and large traders who move prices for profit. These paper markets can suppress or inflate prices temporarily, but they can't change the long-term reality. The real value of silver is tied to its physical scarcity and industrial necessity. That's why many experts, including myself, believe that what's happening right now is not a crash, but a recalibration, a resetting of the system before the next big move. Another thing to remember is that the general public often joins the party late. When silver begins to rise again, and it will, the same people who doubted it will rush back in at higher prices. It's the same pattern we've seen countless times before. Smart investors prepare during the quiet phases, not during the hype. This is the time to strengthen your position, research your dealers, and understand how global monetary trends are shifting. We're in an era where trust in fiat currencies is weakening. Governments around the world are printing more money, debt levels are exploding, and inflation continues to erode purchasing power. Gold and silver are the historical answers to that instability. They don't depend on any government's promise. They're real, tangible, and time-tested stores of value. And that's why, even with the current slowdown, the smart money hasn't left the metals market. It's repositioning. So, while the average investor might be panicking, the analyst's perspective is clear. This phase is temporary, and it's full of opportunity. The people who understand market psychology, who stay disciplined and don't let emotions dictate their strategy, are setting themselves up for massive gains when the next cycle begins. The noise will fade, prices will stabilize, and confidence will return. And when it does, the patience you show today will be the foundation of your future success in silver. Now, let's focus on one of the biggest forces shaping the precious metals market today: central banks. What they are doing right now gives us the clearest signal of where the global economy is heading. Over the past several years, central banks around the world have been aggressively buying gold, and not in small amounts. They've been purchasing at record levels, the highest in more than 5 decades. But what's even more interesting is what this behavior reveals: a deep and growing lack of confidence in the US dollar and in the fiscal management of Western governments. Think about it. For decades, the dollar has been the foundation of the global financial system. Every country held US treasuries as their main reserve asset. But when the US began printing trillions of dollars to fund endless debt, bailouts, and wars, that confidence started to weaken. Nations like China, Russia, Turkey, and even smaller emerging economies looked at this and thought, if the dollar keeps losing purchasing power, why should we trust it to store our wealth? The answer was clear. They turned to gold. This shift didn't happen overnight. It's been building slowly, almost quietly, for years. But now it's visible in the data. Central banks are diversifying away from the dollar, and the first place that movement shows up is in gold accumulation. They're protecting themselves against a potential breakdown in the global monetary order. And if you pay attention, this same sentiment is starting to appear among private investors as well. People like you and me, who no longer trust fiat currencies to hold value over time. This behavior from central banks is a major warning sign. It suggests that the world's largest financial institutions, the ones who actually create money, no longer believe the system is sustainable in its current form. That's why we're seeing stronger interest in physical assets like gold, and by extension, silver. Silver might not be the primary reserve metal, but it tends to follow gold's lead once the revaluation process begins. When confidence in paper money drops, the value of tangible assets rises sharply. Now, if we connect this to current events, the message becomes even clearer. Inflation remains stubborn despite interest rate hikes. Debt levels in countries like the US, Japan, and many in Europe have reached historic highs. Governments are trapped. If they raise rates too much, they crash the economy. If they don't, inflation erodes savings. It's a lose-lose scenario. And in that environment, what do you think the safest option looks like to those in power? Gold. That's why it's being hoarded, quietly, systematically, and globally. For silver investors, this behavior has a delayed but powerful impact. Once gold is revalued or repriced upward, silver tends to outperform on a percentage basis. Historically, when gold moves 1%, silver moves 2% or even 3%. So, this central bank gold accumulation is actually a signal for the next major silver bull run. It's not just about supply and demand anymore. It's about trust. And trust is shifting away from paper promises toward physical reality. You see, the precious metals market is like a mirror reflecting the world's financial stress. The more unstable currencies become, the more valuable real money looks. That's the story unfolding right now. The global financial system is evolving, and metals are at the center of that evolution. So when you see news headlines about central banks buying record amounts of gold, don't dismiss it as irrelevant. That's not just a statistic. It's a warning, a blueprint for what's to come. In short, the actions of central banks today are telling us something critical. They're preparing for a major monetary adjustment. Whether it's a dollar devaluation, a global currency reset, or a shift toward digital money backed by hard assets, it's clear that gold and silver will play leading roles. And for individual investors, understanding this trend now, before the crowd catches on, could make all the difference in preserving and growing their wealth during the next great financial transition. Now, as we move deeper into the analysis, let's turn our attention to what comes next after central banks begin hoarding gold. The inevitable impact on the US dollar and the broader global financial system. When confidence fades in a currency that has dominated the world for nearly 8 decades, major structural shifts follow. We're starting to see that process unfold right now. The cracks in the dollar's dominance are becoming visible, and the implications for gold and silver investors are enormous. For years, the dollar has been supported by trust. Trust that the United States would manage its debt responsibly, that its central bank would maintain stability, and that US Treasury bonds were the safest assets in the world. But over the past decade, that trust has been eroding. The national debt has exploded past $35 trillion, deficits are running out of control, and political polarization has made fiscal discipline almost impossible. Every time the US government faces a debt ceiling crisis or prints billions more dollars to cover spending, the world watches and doubts grow stronger. This growing doubt is exactly why gold has been quietly outperforming. It's not just about price speculation, it's about protection against the collapse of credibility. The same mechanism that is driving central banks toward gold is also pushing individuals toward physical silver. Silver may not be a monetary reserve metal for governments, but for the people, it's a practical and affordable hedge against the loss of purchasing power. When confidence in paper currency fades, silver becomes the people's money. We're also witnessing the early stages of a global de-dollarization movement. Countries like China and Russia are settling trade deals in their own currencies or through gold-linked systems. Even the BRICS alliance has discussed creating a trade currency backed by hard assets. This means that global trade is slowly moving away from dollar dependence. And as demand for dollars drops internationally, its value weakens domestically. That's a double hit: less global support and higher inflation at home. The result? A stronger case for owning physical metals. Now imagine what happens when investors collectively realize that the US can't raise interest rates indefinitely, can't reduce its debt, and can't print its way out of inflation. That's when the real revaluation begins, first in gold and then in silver. History shows that when the monetary system reaches this kind of pressure point, governments eventually reset the system by revaluing gold upward. This allows them to devalue their debt in real terms. And every time gold is revalued, silver follows, often explosively. This is where things get interesting. Analysts like James Rickards and Mike Maloney have already projected potential future gold prices ranging from $10,000 to $24,000 per ounce in such a scenario. If even half of that revaluation happens, silver could easily break into triple digits. That's not speculation. It's simple math based on historical gold to silver ratios and market liquidity. But again, the key isn't just in predicting numbers. It's in understanding why this shift is happening and positioning before it does. The financial world runs on confidence. Once that confidence cracks, everything priced in paper begins to lose meaning. That's what we're seeing now, from declining bond demand to increasing gold reserves and the rise of alternative trade settlements. The global economy is sending a clear message. The dollar's best days are behind it, and the age of hard assets is returning. For investors, that doesn't mean panic. It means preparation. Silver and gold are not just commodities. They are lifeboats in a sea of debt and inflation. When currencies falter, real assets rise. The shift away from paper money won't happen overnight, but every new policy error, every increase in national debt, and every central bank purchase of gold pushes us one step closer to that tipping point. So, as an analyst, my advice is simple. Stay informed, stay patient, and stay physical. Don't get distracted by the daily price swings or the short-term news cycle. Focus on the bigger picture. The slow but inevitable loss of trust in fiat currencies and the return to assets that have stood the test of time. Because when the next monetary reset begins, it won't be announced on the news. It'll be reflected in the prices of gold and silver long before the world realizes what just happened. As we reach the end of today's analysis, take a deep breath and think about where we are in history. The signs are everywhere. Confidence in paper money is fading, governments are drowning in debt, and nations are quietly shifting back to gold. The financial system that once felt unshakable now trembles beneath its own weight. And in moments like this, ordinary people like you and me, have a choice. We can close our eyes and hope it all holds together, or we can prepare. Because when currencies fall and systems reset, only those holding something real, something tangible, stand tall. Gold and silver are more than metals. They are time-tested witnesses of truth. Empires rise and fall, yet they remain. Every ounce you hold is a statement, a promise that you will not let your future be written by inflation or policy failure. You're taking back control, quietly, strategically, while the world still believes the system is fine. So don't lose sight of the bigger picture. Yes, markets will dip, prices will swing, fear will rise. But in the end, those who stay steady, who understand what's really happening, will emerge stronger. Because history rewards patience, not panic. This is Gold Rush Reporter, reminding you that financial freedom isn't about luck. It's about knowledge, discipline, and preparation. If today's deep dive gave you clarity, hit that subscribe button, tap the bell icon, and join our growing community of thinkers, stackers, and truth seekers. Together, we're not just watching history, we're preparing for it. Stay smart, stay strong, and as always, keep stacking. Because the real rush, the gold rush, has only just begun. This is Gold Rush Reporter signing off.